So in this lecture, we will not start the next topic. In my opinion, you need to practice a little bit more questions for marginal costing and absorption costing. So in this lecture, we will focus more on the practicing questions for absorption and the marginal costing. So, and then we will see at the end of the lecture how we go. If we have enough time, then we may continue to the next topic. If it's not, then we will study next topic next week, Friday. All right. So here is a question. So can you see the question? Can you see that? Is that clear for you? Is it clear to read? Okay. So, so in this question, you have to calculate net profit, right, using absorption costing and marginal costing, like as normally we do that. So you will do absorption costing first, and then we will check the answer, and then you will do the marginal costing. So I quickly have a look, provide you all the information. So Lone Star Product Company has a maximum productive capacity of 100,000 units per year. Normal capacity is 90,000 units per year. Standard variable manufacturing cost. This is variable manufacturing cost is 20. Fixed factory overhead is 450. Variable selling expense is 10 pounds per unit. Fixed selling expense is 300,000 per year. And unit selling price or sales price is $50. We have some additional information regarding the units. So we have a sales unit, we have production unit, we have opening inventory, which is 5,000. So now you have to calculate profit using absorption costing and marginal costing. All right. So do this question. Calculate net profit for absorption costing. When you finish, then let me know and we will check the answer. Right. So do that. So how did you calculate cost of goods sold? Yes. So you can see manufacturing cost. You can see in your question, you have information about variable manufacturing cost, which is very clear, which is 20. And you have a fixed manufacturing, which is 450 for 1 year. And you can see your normal capacity is 90. So 20, which is this variable manufacturing, plus 450 divided by 90, which will be 5. Yes, which will be 5. So 20 plus 5, it's 25. Multiply by how much is opening? Do we have any opening? How much is opening inventory? Sales is let me check. Yes, sorry. Sale is 4 million, not 400. 4 million. Thank you. So how much is opening inventory? Opening is 5,000. Plus, did we produced anything? How much is production? 85. Yes. Production is 85 minus how much is closing? 10. Yes. Closing is 10. So how much is 80? 80 multiplied by 25. So how much? Cost of goods sold? How much is cost of goods sold? Cost of goods sold is 2 million. That's right. So this number is 2 million. So your gross profit is 2 million minus non-manufacturing cost. How much is non-manufacturing cost? So we can calculate non-manufacturing cost here. So how much non-manufacturing cost? No. Why did you 300,000 divided by 90? Why you need to do that? Because non-manufacturing cost, we do not calculate using production units, right? Non-manufacturing cost, we do not use as a production unit. So you can see non-manufacturing cost, we have a variable non-manufacturing cost. Variable non-manufacturing cost is $10 per unit. So 10 multiply by using sales units, and sales units are 80. You are right. This number is right, which is 800,000, right? Plus fixed non-manufacturing. Fixed non-manufacturing cost, fixed non-manufacturing, which is 300,000 for 1 year. That's it. That will be 300,000 here. This is non-manufacturing. You don't have to use production unit. The way you are calculating, that's production unit. Non-manufacturing cost means non-production. It has no relation with production unit. So why you doing 300,000 divided by 90? All right. So your non-manufacturing will be 1 million and 10,000. No, 110,000. 1,100,000. Yes, 1,100,000. 1,100,000. Did you understand this number, everybody? This one is okay. Did you understand this? Okay, so it will be 1,100,000. That will be your non-manufacturing cost. 1,100,000. That's your non-manufacturing cost. All right. So net profit. So which is 900,000. It's your net profit. All right. Everybody understand absorption costing? How to calculate cost of goods sold or non-manufacturing cost? Is that okay? Absorption costing, say something, yes or no? Okay, if yes, then move on to marginal costing. Using this information, calculate marginal costing, all right? So do it now. So now start with the sales. So sales. So how much is the sales? How much is the sales? It's 4 million. Yes, 4 million, which is the same like as absorption costing. Sales minus variable manufacturing cost. Right. So let's have a look at the variable manufacturing cost. So here, right here. So I think so. Variable manufacturing cost. Formula is variable manufacturing cost per unit multiply by opening plus production minus closing. So how much is variable manufacturing cost per unit? Variable manufacturing cost per unit, how much? 20. Yes, it will be $20 per unit multiply by opening, production, closing will be same, which is 90 minus 10 is 80. All right, it will be 80. So multiply by 20. So how much is your variable manufacturing cost? $1,600,000. 1,600,000 minus variable non-manufacturing cost. So how much is variable non-manufacturing? So we can calculate here. Variable non-manufacturing. How much did you calculate variable non-manufacturing? Yes, 800,000. which is 10. Selling cost is a 10 per units multiplied by sales unit, which is 80, so 800,000. So it's 800,000. Okay. Next. So here is your contribution margin. Right. How much is contribution margin? $1,600,000. Yes. 1,600,000 minus fixed manufacturing cost. How much? Fixed manufacturing cost 450,000. 450,000 and minus fixed non-manufacturing cost is how much? 300,000. Yes, 300,000. So how much is your net profit using marginal costing? 850,000. That's your profit. All right, under marginal costing. Right. Any questions for question 4? Any question for this? Or we move on to the next. Okay, no questions. So let's move on to the next question. So I'm gonna give you more questions to practice, maybe question 5 and question 6, and you will do the same absorption costing and marginal costing. All right, so let me send you next one. So as I said, in this session, we will only practice the marginal and absorption costing. So I added 3 more questions. So question 4 is just finished. Question 5, 6, and 7. All right. So let's start with question 5. You calculate net profit for question 5 using absorption costing, and then we will check the answer. All right. So do it now. So we start question 5 with absorption costing. So here is absorption costing. Absorption costing. Right. So start with the sales. How much is the sales? Tell me quickly, how much is the sales? Sales is 500,000, which is 25 multiplied by 20, which is 500. 500,000, right? Minus cost of goods sold. How do we calculate cost of goods sold? Okay, you know that formula of cost of goods sold is a manufacturing cost per unit, right? Multiply by opening plus production minus closing. All right, but we already have some information given, like as here, total direct material, total direct labor, total variable cost, and total fixed cost. Means we have all information regarding material. We have material plus labor plus overhead, and that's equals to cost of goods sold. So this number from here until here, this is your cost of goods sold, which is 2 plus 1, 300, 300, 400, 440. Can you check again? Is it 440? That's your cost of goods sold. So calculate again, how much is your cost of goods sold? So you don't have to calculate per unit. If per unit information is given and you have to find units, per unit multiply by number of units. This is your number of units. This is called cost of goods sold unit, right? So manufacturing cost per unit multiply by number of units is cost of goods sold, right? Cost of goods sold means manufacturing cost per unit multiply by cost of goods sold units. So the question we have practiced before, question 1 to question 4, we calculate this number and this number to find this number, because this number is not given in the previous question. If you have a look from 4 to 1, all right, but in this question you have direct cost of goods sold is given, so you don't have to find manufacturing cost per unit, all right, or you don't have to find units. So we have all information here, so that's why your cost of goods sold will be 200 plus 100 plus 80 plus 60. Did you understand that? Okay, so if you understand, so tell me how much is your cost of goods sold? Yes, 440. So 440,000. That's your cost of goods sold. And your gross profit is a 60, right? Minus non-manufacturing cost. How much is non-manufacturing cost? 60, 40, 40 or 60? Non-manufacturing is 40, not 60, 40. So your profit is 20,000 under absorption costing. All right, under absorption costing, your profit is 20,000. Everybody understand? Okay, so let's move on to the next, which is marginal costing. So marginal costing. So let's start marginal costing with the sales. With the sales. How much is sales? It will be same, right? How much is the sales? Quickly tell me and then we move on, because still we have 2 more questions to finish. Yes, 500,000. Minus variable manufacturing cost. How much is variable manufacturing cost? 380, that's right. 380. Why 380 is direct material, which is variable manufacturing, direct labor, variable manufacturing, and variable overhead only. So these 3 are variable manufacturing cost. Minus variable non-manufacturing cost. What do you think variable non-manufacturing cost? Zero. No, variable manufacturing cost will not be zero. Generally, selling cost is known as a variable cost, but here it's a selling and administration both, right? Selling and administration both. So we assume this selling and administration cost will be variable cost because selling cost depends upon number of units, right? Selling cost depends upon number of units, number of sales units, right? Selling expense or selling cost, right? So if you have a look, the previous question where you see that selling expense, normally they are saying variable in the previous question, but generally selling expense means the expense we spend to sell the product, sales units, which depends upon sales units. So that's why we can assume this 40,000 as your variable non-manufacturing, right? So minus 40, all right? So contribution margin. This question do not actually clarify whether this 40,000 is it selling, or because it's saying 40,000 is a selling and administration both. But as I said, we can assume that this selling expense will be considered as variable non-manufacturing cost because it starts from the word selling. So we assume that it's more involved in selling, right? So contribution margin is how much? 80,000. Contribution margin is 80,000. I think it's gonna be same. And minus fixed manufacturing cost. How much fixed manufacturing cost? Fixed manufacturing cost. Yes, 60. So that will be 20,000. So it's gonna be like same here because we did not estimate any per unit. So by that reason, your answer for marginal costing and absorption costing is same. But unfortunately, in this question, we have some lack of information. Like I told you, selling, because of this information, the profit under marginal and absorption costing is same. But generally, profit under marginal and absorption costing is not same. That you have practiced like 4 questions, and you found that in all these previous 4 questions, your profit under marginal and absorptions are not same because you have a specific information regarding the variable manufacturing cost, right? And variable non-manufacturing cost. But in this question, we are not using any kinds of per unit. That's why we're just simply using numbers up and down, which is contribution margin or manufacturing, non-manufacturing. So that's why your profit under these 2 methods are same. All right. But anyway, this is the ideas for this question. So did you understand this question number 5? Any questions for question 5? No question. So no question. Let's move on to question 6. So you have all informations, which is direct material per units, labor per units, variable factory overheads per unit, fixed factory overhead per unit. So total cost, manufacturing cost is a $15 per unit. And you have some other information for the 2 months, March and April, right? And you have unit produced 12 and 8, unit sold 8 and 12, selling and administration. So, but this question is they make things very clear. Like all these selling and administration are fixed. So we do not have a variable non-manufacturing cost. So all are variable fixed, oh sorry, all are fixed non-manufacturing. So this is very clear. Selling price is 20 and we do not have any opening inventory. So calculate. So let's have a look at the absorption costing under absorption costing for question 6. So let's hear absorption costing. Absorption costing. So let's start with the sales. So we have 2 months for March and April. March and April. So tell me sales for March. Sales for March. $160,000. 160,000 minus cost of goods sold. Right. So let's calculate the cost of goods sold here. Cost of goods sold, which is manufacturing cost per unit multiplied by opening plus production minus closing. Right. So how much is the manufacturing cost per unit? Total manufacturing cost per unit, 15. Yes, it's very clear. 15, which is here. All right. Multiply by how much is opening for March? 0. Plus how much we produced? 12,000 minus how much is closing? 4. 4. So which is 8. 8 multiplied by 15 is how much is your cost of goods sold? 120,000. So gross profit is how much? 40. Yes, 40 is a gross profit minus non-manufacturing cost. How much is non-manufacturing cost? 12. Yes, it's 12. So how much is net profit? Net profit is 28. Yes, that's your answer, right, for this question. So let's move on to the marginal costing, right? Marginal costing. Oh, we forgot for April. So we have to check for April too. So how much is the sales for April? Same, 100 and no, it's not same. It's different. So it will be 240,000. And cost of goods sold for April. How much is cost of goods sold for April? Manufacturing cost per unit will be same, which is 15, right? Multiply by how much is opening for April? This is March. It was March and that's for April. Opening is 4,000, yes, plus how much we produced? We produced 8,000. And how much we close? How much is closing? 0. 0 is closing. So 12 multiplied by 15. So how much is cost of goods sold for April? 180. So how much is gross profit? 60 minus non-manufacturing cost for April. Non-manufacturing cost for April 12, it will be same, yes, 12. And how much is net profit? It will be 48,000. So absorption finished. Let's move on to the marginal. So we have 2 months, March and April. So we start with the sales for March. Sales will be same, which is 160 for March, minus variable manufacturing cost. So formula is variable manufacturing cost per unit multiply by cost of goods sold units. All right. So how much is variable manufacturing cost per unit for March? 12. So 12 means we removed this one out, right? So 5 plus 4 plus 3 is 12. So $12 per unit multiplied by, it will be same, which is 0 plus 12 minus 4, which is 8,000. So 12 minus 8. How much? 96. Yes. 96,000 minus variable non-manufacturing cost. How much variable non-manufacturing cost? How much? Tell me. Variable non-manufacturing. Quickly tell me how much is variable non-manufacturing? Yes, it's 0. All right, it's 0. So we have contribution margin. So how much is contribution margin? How much is contribution margin? 64, yes. Minus fixed manufacturing. How much is fixed manufacturing? Fixed manufacturing, how much? $24. How did you calculate 24? 8 multiplied by 3. Let me check. No, it will not be 8 multiplied by 3. So always remember, when we calculate fixed overhead, we always, under marginal costing, we always calculate total fixed overhead. We do not calculate fixed overhead for production unit. All right. So what do you think? As per this question, how much will be the total fixed overhead? for the month of March? What do you think? Total fixed cost. Because if you say that 8 multiplied by 3, 8 is your units. I know why you're using 8. 8 is your cost of goods sold unit, right? Cost of goods sold unit makes sense, but that makes sense according to absorption costing. Under absorption costing, we calculate fixed cost using production unit for this month, this period. But under marginal costing, what we have learned, we do not calculate fixed cost as per production unit. We calculate total fixed cost. So what do you think? How much will be the total fixed cost? How much is total fixed cost? Tell me. Total fixed cost will be 12,000, which is this unit produced. How many units we total produced? We sell 8. So that's why you're using cost of goods sold unit 8. So that's why under absorption costing, we calculate fixed cost using production unit. But as I said, we have to calculate total fixed cost. All right. Total fixed cost for the month of March is 12,000 multiplied by what? Multiply by? Quickly tell me, multiply by what? 3, yes, multiply by 3. 36,000 for the month of March. All right. Fixed cost for the month of March. So 36. 36. So it will be 28. Can you check? How much is net profit? Oh, we have to minus. Wait. We have to minus. Wait. So fixed manufacturing cost is 36,000 minus fixed non-manufacturing cost. How much is fixed non-manufacturing cost? Fixed non-manufacturing cost, quickly tell me. 12. So how much is net profit for March? How much? Hmm? 48. Can you check again? Is that 48? $16. Yes, 16. It should be 16. 16 is the profit for the month of March. Did you understand that? So always remember, when we are calculating fixed cost under marginal costing, do not use production unit for current period. Like some of you are trying to use 8,000. 8,000 we use only for absorption costing. That's why under absorption costing, we use 8,000. Under absorption costing, we use 8,000 multiplied by, inside have a 3, right? So we multiply by 3 under absorption costing. But under marginal costing, fixed cost will not be calculated using production unit. So we calculate total fixed cost, not fixed cost for that period only. So total fixed cost is 12 multiplied by 3. All right, that's your marginal costing for March. Now let's move on to the April. So your sales for April is 240, right? 240. Variable manufacturing cost. How much is variable manufacturing cost for April? April, this is for March, and this is for April. For April, it will be same, which is 12. Multiply by how many units? Same like as here, is 12. So 144,000. Can you check again? Variable manufacturing cost for April, how much? 144,000. All right. 144, not 114. Variable non-manufacturing cost is 0. So how much is contribution margin? 126, right? Minus fixed manufacturing cost. Minus fixed manufacturing cost. Tell me, minus fixed manufacturing cost for the month of April? Yes, 24. Why 24? 8 multiplied by 3. So that's 24. Minus fixed non-manufacturing. Fixed non-manufacturing. 12. Yes, it's 12. So how much is your net profit? 90 or 60? Check again, 90 or 60? It must be 90. Contribution margin is not 126. How much is 96? Okay, so some of you made a mistake in calculations because I don't have calculator with me. So 96 minus 24 minus 12. So it will be how much? 60? Net profit is 60? Yes, 60. That's all for question 6. Question 6 is finished. All right. So any question for question 6? Any questions for question 6? No questions. All right. So now question 7. So, but we don't have enough time to finish question 7, and I didn't give you break today, so that's why we finish early. So I mean, just 10 minutes to finish. So I'm going to leave you now. So this question 7 is your homework. All right. This question 7 is your homework. So you finish this question 7 at home. Same thing you have to do. You have to calculate absorption costing, net profit, right? And variable means marginal costing. I hope you remember the first lecture where I explained that another name of marginal costing is absorption costing. The first lecture of this marginal and absorption costing. So net profit. So you have to calculate net profit for marginal and absorption costing for question 7. All right, so we stop here. So just I added question 4, 5, 6, and 7. So we already finished question 4, 5, and 6, and question 7 is your homework. All right. So any question for today's lecture? No questions. So we stop now. So I'll see you next week, Friday. All right. So next week we have class. So next week, Friday, we will finish this question 7, and then we will start a next topic, which is break-even points or cost volume profit analysis. And then at the end of next lecture, we will discuss about final exam. All right. So next lecture is the last lecture. So that will be in the university. I mean, the next lecture will be in the class. All right. So I'll see you next week in the class. All right. Thank you. Bye-bye. So how much is a fixed manufacturing cost? A fixed non-manufacturing cost, 12,000. That's right, 12,000. So how much is net profit for the month? 60,000. That's all for question 6. So that's the answer for your question 6. So question 6. This is your question 6. So question 6 is finished. Absorption and marginal costing. All right. So any question for question 6? Is that okay? All right. So if no question, let's move on to question 7. So here is question 7. So calculate marginal and absorption costing for question 7, and then we will check the answer. All right. So start calculate question 7. Okay. So let's start with the absorption costing for question 7. Right. Absorption costing for question 7. So we have 3 months, October, November, and December. Right. So we have October, November, and December. So let's start with the sales. How much is sales for October? $66,000 minus cost of goods sold. How much cost of goods sold did you calculate? So we have to calculate manufacturing cost per unit, right? How much is manufacturing cost per unit? How much did you calculate manufacturing cost per unit? 15. How did you get 15? 10 plus 10 is here, plus, how did you get 5? Yes, so 5 is 360, 360 divided by 360 divided by 72, all right? So which is 15. So total is 15. 15 multiplied by opening 0 plus production. How much is production? Quickly answer, how much is production? 6. 6 is production, minus how much is closing? 3 is closing. So 3 multiplied by 15 is 45. So how much is net profit? So how much is net profit? For October, 21,000. 21,000. Okay. Minus non-manufacturing cost. How much is non-manufacturing cost? How much is non-manufacturing cost? 0. Why 0? Why it's 0? What's this? 48,000. 48,000. So no, not 48,000. Not 48. How much? Quickly tell me how much is non-manufacturing. You did many questions. Yes, 4,000. 48 is for 1 year. So you have to divide it by 12. So 4,000. So net profit is 17. Right? That's your October. Now let's move on to the November. How much is the sales for November? 88,000. Cost of goods sold is 15 multiplied by opening 3 plus production is 1,000 minus closing. How much is closing? 0, right? So 4,000 multiplied by 15 is 60. Cost of goods sold is 60. So net profit for November is 28,000 minus non-manufacturing, which is same, 4. So net profit is 24. All right. Let's move on to the December. How much is the sales for December? 132,000. Cost of goods sold for December. How we get it? 15 multiplied by opening is 0 plus production is 8 and closing is 2. So which is 6,000 multiplied by 15 is 90, right? 90. So how much is gross profit? 42. How much is non-manufacturing? Same, 4. So how much is net profit? 38. That's all. That's absorption costing for 3 months. Understand? Yes or no? Yes. Now marginal costing will be your homework. Marginal costing is your homework. All right. So I will check marginal costing next week, Friday, in the class. All right. Because next week we have a class, the last lecture. All right. So next week we will finish this marginal costing question, and then we will start with the next topic, which is cost, volume, profit, and then we will discuss about final exam. Understand? So any question for today? Any question for today? No questions. All right. If no questions, then we stop here. So I'll see you next week in the university. Goodbye. Thank you.